I have a pleasure of moderating another panel here today. This one is focused on the future of real estate investing and is for future of real estate in general. And I feel like it's an area of fintech that hasn't been explored and covered as much as others. So I want to quickly just have you guys explain what your companies do in quickly like a minute or so, and then you explain where you guys invest in real estate at Fifth Wall. So we'll start with Ryan.
All right. Good afternoon. My name is Ryan Williams. I am the CEO and co-founder of Cadre. And I started Cadre a little less than 4 years ago because I thought more people should have an opportunity to truly own their futures. I wanted to reinvent how real estate and alts investing worked, and I also want to reinvent and reimagine who could participate. So we're building the world's first digital marketplace for alternative investments. We're focusing on commercial real estate as our beachhead asset class. We've closed more than $1.5 billion in asset value on our platform over the last couple years. We recently announced a key part of the vision, which is more than just allowing more people to buy real estate, but also sell. So the establishment of the first online direct secondary marketplace for real estate. We announced that last week. And we're excited about the future. And the future really for us is allowing anybody to buy and sell interests in direct real estate buildings like they buy and sell stocks. And we think people are underallocated to alts because of a lack of access and a lack of liquidity. And we plan on reshaping and changing that paradigm.
Got it. Right. JD?
Cool. So at Opendoor, we're basically creating liquidity for residential real estate. So right now, the typical process takes 90 days. You have people coming in and out of your house. You have all these other things that come up. You have to do repairs. It sucks. What Opendoor does is make an instant cash offer on people's homes so they can close on their timeline. And what that enables them to do is take the equity from their old home and move it into a new home, like you might trade in a car, and make it one transaction instead of two. And so over the last year, we've grown from doing about $1 billion at the beginning of the year, an annual run rate, to about $4 billion right now. And gone from 6 to just shy of 20 cities.
Wow. Okay.
Great. Good afternoon, everyone. I'm Vic Chawla. I'm a principal at Fifth Wall Ventures. We are the largest real estate-focused technology venture fund. Our capital base actually comes from the largest owners and managers of real estate in the United States across all the major subsectors of real estate, including residential, hospitality, industrial, et cetera. And our thesis is that there is a huge opportunity in the real estate asset class to bring great technology companies and change the way business is done. It's the largest asset class on earth, and yet one of the biggest laggards. And so our fund is focused exclusively on investing in great businesses, one of which is on the stage in Opendoor, and one which we missed, and really build out a great investing franchise focused on the real estate asset class.
Got it. And you mentioned technology. That's something that, if you guys were here earlier, Matt Harris mentioned that the reason he considers real estate part of the fintech landscape is that a lot of the problems in the market are problems that can be solved with fintech solutions. So why don't you guys touch on how you guys are using technology to sort of better the real estate process and expand on that platform?
Sure. So we think about tech in kind of 3 ways. One is the product user experience, so how our users engage with what we're offering them. The second is really the automation of workflow and process, so that's everything from being able to invest in a building, sign a document, fund capital, get reporting analytics, trade from a secondary perspective. And third, which we're most excited about, is data. And that's really leveraging information and unlocking information to drive greater consumer value. So that we can make better decisions and ultimately our users can as well. So I agree with Matt's point on the tooling that's really enabling a lot of evolution in the space.
Mm-hmm.
Yeah. There's little to no advantage to not using data and analytics in any business. And that's even more so true in the real estate asset class, where the industry has been slow to adopt new technologies. And often it requires a new full stack business to be a new entrant and do that, because the culture and DNA of businesses have to be aligned from a technology perspective to really build out those kinds of businesses. And I think that's a great point that Ryan made.
Yeah, and I think that's sort of how Opendoor came about, is we had this insight that we could value homes sight unseen extremely accurately, far more so than had ever been possible before with this growth of data, the improvements in machine learning and AI. And instead of selling that, we just basically trade on it. We make that offer for full market value to someone for their house, and they can decide if it's fair. If it's too low, they will say no, and if it's too high, we'll lose money. And so data, and in our case, machine learning, is the underpinning of our entire business. And that's kind of the technology advantage we think we have for the long term.
Got it. And what about some of the marketing standpoint? Because Ryan, when I think of commercial real estate, and you guys are marketing towards like family offices, hedge funds, and others are the ones that have, until last week, opening it up a little bit, have been investing in your platform and on it. How do you go about marketing for something like that? And then the same thing with Opendoor. Like, usually people in big cities do not own their homes, so you have a different market than a lot of fintech companies have when they're doing their marketing efforts.
Yeah, so in our case, we made the decision we want to sort of start at the top of the investing pyramid. So we wanted to start with institutions, family offices, pensions, endowments, really to build credibility, to give us critical mass and scale. And we thought by doing that, we'd have the optionality to go down market a bit. I think there have been a lot of crowdfunding companies that have taken the opposite approach, and I think you will see some bloodshed in that space, because what it results in oftentimes is adverse selection, not really scalable models, and litigation risk. And so we started at the top, and we spent the first couple years really building a world-class team with a track record. We began creating relationships with banks, a la partnership we established with Goldman Sachs. But the vision's always been the end user that we want to focus on is the individual. And we saw that in the average individual's allocation to alts and real assets is in the mid-single digits, and most in their homes. The average institution's almost 4x that. And so what's driving that discrepancy? Well, it's a lack of access and a lack of liquidity. But first, we had to create the trust with the core platform. So we've now really established trust with the institutions, and we're beginning to roll out to millions of accredited investors, which is the next phase of the business. And then ultimately, it will be about unlocking access for everybody. But the playbook we're taking and making is not that dissimilar from playbooks other companies have taken, right? Look at Facebook. Started with Harvard undergrads, right? Then went to other Ivy League schools and colleges and high schools. But they created critical mass trust and brand equity with one very focused market. And that's what we're doing right now, and now we're beginning to unlock access.
Mm-hmm. I'm a big believer that marketing should be part of your product. And so one of my favorite things about Opendoor is when we acquire these homes, we hold them for about 90 days on average. The way that you tour a home today is like you call an agent, you say like, this is what I want, or I want to see this house, and you have to build out this kind of precise plan. For us, every home we own, which is now thousands of homes, you go up you download the Opendoor app, you hit a button, and the door unlocks itself. And so you can tour 10 times as many homes as you normally would before picking one to buy. So our buyer remorse numbers are way lower than the industry average and things like that. But then those people who are touring homes learn about Opendoor. And then those people request offers on their homes. And so that becomes this like flywheel effect, where as we get more homes, we get more sellers, we get more sellers, we get more homes, we get more homes, we get more buyers.
Right.
And those are the best signs of the greatest marketplaces, right? Where your buyer and seller becomes the end user.
Mm-hmm.
Yeah. And also that first experience being such a magical moment where you just hit a button and the door unlocks itself, like that's marketing. And that's really the technology kind of intersecting with it.
And I think from the investor perspective, one of the things we've really seen is the great businesses create amazing experiences. And if you don't have an amazing experience, consumers are not drawn to a platform. And without that, and without being very laser focused on marketing, customer acquisition, and doing it in the right scalable way, it's very difficult to build a great technology business.
Yeah.
I went to school in Missouri, and it's called the Show Me State. Like, don't tell me, show me. And I think so much marketing tries to like tell you. It's so much better just to show someone, and then they'll believe it. Otherwise, you're just like, I'm going to give you more money for your house, and it's going to be faster, easier, and like completely on your timeline. They're like, BS. But if you show them, like, and you kind of prove it over time, they're way more likely to give you a shot.
Right. So from the investor perspective, when you're looking at these companies, they're going to have to spend some money on marketing. You want to look at like the tech stack that they have. What are some things and like questions that you're asking in terms of figuring out what is a good real estate company to invest in these days?
Yeah, it's a great question. So we sort of bifurcate our types of businesses into two flavors. One is the full stack business, and the other is the tech retrofit play. So the full stack business is an end-to-end experience, similar to these gentlemen's businesses, where you go from customer, whether consumer or business, all the way down the value chain. Other types of businesses on the technology retrofitting plays tend to be software businesses, where you're bolting on a software solution to an existing business stack. And with each of those, you have to be very careful to calibrate what what amount of money can you spend sustainably to acquire the customer versus the value that that customer will provide. And so customer acquisition cost analysis and lifetime value forecast are key parts of what investors look at to ascertain which businesses will be able to build strong franchises.
Got it. And then what are different areas of expansion for you guys? Because I know like Opendoor, I'm not going to like go buy a home every single year and want to sell it again, but I'm sure you want users coming back to your platform again and again. And then the same thing with, the institutional side. Would that be adding in more consumers like myself or expanding into different types of products outside of real estate?
Yeah, so we think of home ownership as like a life cycle, right? You have that period of time when you buy a home, then you own it for a while, then you sell it and move into a new home. And today, we're focused very much on that transaction, and we're going to go really deep into that. So it's not just buying and selling, but it's also capturing the mortgage. It's capturing the title and escrow. Like, no one cares about that crap, right? Like, no one's buying a home thinking, like, what I really want is a mortgage. Like, they just really want to get into their next home. And so if you can simplify that down to a click, like, hey, your old home was $1,500 a month, and you needed $200,000 invested in it. This new home is $1,900, and you need $220. Contribute $20,000, and this is your new price. Hit go. And then you can move, and that can be across the country and enable economic mobility in that way. That's the focus today. I think going forward, you're going to see us doing a lot more in that, maintaining your home over time, because we have such a gigantic renovations network and repair network. We can tell you proactively, hey, like you should get your roof checked. You should, if you have a problem, you already have the Opendoor app. Hit a button, we'll send someone out and give you below market rates on fixing it. And it should be really easy to maintain and own your home.
Got it. Ryan?
Yeah, I think ultimately we want to really be the one-stop shop for anyone to grow their personal P&L. So what does that mean? It means we want to expand both supply and demand. On the demand side, yes, we want you to be able to invest, Julie. We want you to be able to have access to the product. As long as you write nice things about us. No. But seriously, we want to be able to expand to any individual. And we're starting again, institutional side, we've now recently announced the first online managed portfolio for individuals, so now they can invest with lower minimums. Historically, it was like $250K. Now you can be into a deal for $25K.
And what does that look like compared to me going and investing in, a REIT or investing with someone like a Blackstone?
Yeah, so there's three ways to really get access to commercial real estate. We think all three are broken. That's why we started Cadre. You can go direct. Direct means you need to know somebody. Most people don't know operators to put deals together, and the ones they know, they shouldn't be partnering with, right? There's a reason they're coming to your friends. So there's an adverse selection dynamic. The second way rather to invest is through REITs. And REITs historically have been how folks have gotten liquidity and exposure to real estate. The issue with REITs, you're ultimately investing in something that's still correlated to the equity markets. And you're also investing in something that is a share in a company, right? Not a direct underlying asset. There's different tax benefits from a depreciation perspective to owning direct. And so we thought the REIT market was really just another proxy for the stock market, albeit with a different wrapper. And then the third way to invest is through funds. And I came from a fund. I worked at Blackstone previously. Incredible model that they built that is really the gold standard in many ways. Challenge is it's opaque, right? So if you invest in a fund, you don't really know what's underneath that fund wrapper. It's a liquid, so when there are market swings, you're prone to those without optionality to get out, and it's costly. There's layers of promoting carry. And so I saw that kind of challenge, and I said, well, what if I could build a model where you had the transparency of going to a friend, you had the fee model of going to a friend, you had liquidity of a REIT, but the quality of a fund. And so to answer your question, those are the three ways to invest. If you want to invest in a REIT, yeah, you can have lower minimums because you're investing in a stock. If you want to invest in a fund, you still actually have a pretty high bar to participate. So we're unlocking access, we're unlocking liquidity for more people, and you're not sacrificing on the quality.
I think what you hear in both businesses is just how tremendous the opportunity is. There are so many ancillary business lines and adjacent business lines for them to expand into. We're obviously bullish on the entire space, but in both of their businesses as well.
You guys don't need to pay for marketing. You got this guy right.
No, I wish we
We paid for that.
Yes, he had to pay. He had to pay for that.
Venture capital isn't cheap.
Yeah. I mean, actually, I think he's the one giving you money, so you're okay.
Yeah, that would I wish it went that way.
Would you ever list residential type investments on your platform, or are you focusing more on the commercial side of things?
So it's interesting. Everyone says residential, and they have different definitions of residential. We actually, most of our deals are residential. They're multifamily. So you know,
like
more than
apartment
half of our
complexes.
portfolio is multifamily. We like the space. We think people always need somewhere to live, as you guys believe as well. We think we get kind of better economies of scale with multifamily. Then we have office. We've looked at hospitality, industrial, et cetera. We actually have looked at some portfolios of single-family homes and sort of aggregating those portfolios in a more institutional way. So potentially, maybe there's a partnership opportunity.
Yeah, I was gonna say maybe they've got some homes on their books that they want to get investors in on, and
Right,
there you
yeah.
go.
So
That's your,
potentially, yeah.
that's
The
your
first, that's a lot of pressure for a stage deal.
Right, right.
I got the term sheet backstage, so yeah, we'll be.
Another question on that front, though. I feel like going out and sourcing commercial real estate and even residential real estate takes some manpower. How are you using technology behind that to take out some of that legwork instead?
Yeah, it does. I mean, the average deal that we're closing on our platform is north of 75 million of value. So these are bigger properties and assets, and we're almost fractionalizing bigger assets versus trying to go out and do, you know, $100, $2 million properties. Now, the technology we're building should give us that operating leverage over time, but what we decided is we want to start at the top of the market, build a world-class team. So we have a lot of folks from Blackstone, Goldman, Baupost, but augment their underwriting, their due diligence, their vetting of these properties through technology. So the way we think about it is we want to be a couple times more efficient in the early days relative to, you know, what we did in my past life in terms of underwriting deals. And the way we do that is first and foremost creating a more efficient content management system. So whenever information comes to us and through us, we want to be able to aggregate third-party macro information, financial information about the properties, and just standardize that data. And the bar is pretty low. I always say that the biggest technological jump in most of real estate the last 20 years was like fax to email, right? So it's a pretty low bar, and so if we can just standardize the information in a way that lets our analysts underwrite it quicker, that's like a great step forward. And then the idea is as we aggregate this data, both on the properties we review and vet and macro, we can start building better predictive models that give us greater conviction in where we want to invest. So then you almost create tools for our investments team that allow us just to be almost like, you know, supercharged investment professionals. And that gives us the operating leverage so we don't have to keep hiring people and throwing people at problems. We can leverage the systems.
Got it. And how often are deals coming through your platform, and what's like the average size of each one?
Yeah, so 1 to 2 a month is the frequency today. The average size, a little bit more than 70-ish million or so. We're seeing, though, dozens of deals every week. Our conversion rate's a little less than 2%. So
of the deals that you see, you act on about 2% of
right.
them.
But what we do with the other 98% is we actually store all that information in our own asset library. So basically, that information becomes data that, again, we can leverage for future investing decisions.
Got it. Okay.
It's funny because I have a lot of the same answers as Ryan, but it's just very different because we're buying and selling thousands of homes a month.
Right.
And I struggle when anyone's like, so what's like the biggest challenge at Opendoor right now? And I'd like pull back from saying painting houses is really hard. Like painting 1,000 houses a month is really tough. But it is, and like you have to build the operational tooling and all of these, we call it the AWS for real estate. Like all of these internal kind of businesses that all have to work and are built on technology that let us do things like renovating thousands of homes a month at scale properly, really well, so every house is clean, functional, safe, ready to move in.
And the beauty of both of our businesses is what we're doing today is we're creating the tooling internally, right, for our own teams. The way we think about nonlinear scale, so how do you go from 1 to 2 properties, per month to thousands, is you begin leveraging the software, the tools we're building in-house to make us more operationally efficient, and you extend and almost provide like self-service tools for operators so they can do better reporting and analytics and portfolio management. And Jeff Jordan, one of our investors, came and did a talk at our office, and he said, similar to eBay, right? Come for the tools, stay for the ecosystem. And so we want to be able to begin extending these tools to owners so that they can come to us for more than just money, but also ability to grow their business. And then I think you have a really powerful set of network effects.
And
You
from
can
our
keep eating
perspective,
LG
one of the
as
things
well.
we see is the industry itself is adapting. So industry participants are seeing great technology businesses be built, and they want to participate. So Fifth Wall was very proud to announce, in conjunction with Opendoor and Lennar Corporation, a trade-up program where certain buyers in Lennar markets were able to trade up from their existing home into a new home using the Opendoor platform. And to the answer of scale and being able to do that over thousands of homes, leveraging the footprint of the industry is actually very powerful in this specific asset class because you solve the distribution risk problem. Real estate, as we know, has very low technology usage. So it's not so much is the solution better than a better mousetrap than the status quo. It's that plus can you get adoption and can you have enough distribution to build a business at critical scale? And we at Fifth Wall believe the industry has a unique ability to help influence the outcome, and sort of we're very proud for the work we've been able to do with the Opendoor business.
This is like the best endorsement any VC can give to themselves. Like most come in and say, you know, like we'll be value
Tough crowd.
add and we're going to help, and then it like rarely happens. Fifth Wall actually connected us to Lennar, which has led to a home builder program that's doing just shy of $1 billion a year now already, and that's obviously like huge testament. But I love the model of being able to say like, hey, bootstrap off the industry instead of having it come in later.
Right, and I think what you see is other industry participants, and specifically the ones outside of real estate, saw what happened when they weren't engaged with great entrepreneurs. They got put out of business. And I think the real estate asset class actually has a lot of value they can deliver if done correctly, and we're excited to see in what other veins that can be realized within real estate tech.
Yeah, and what opportunities you see from these guys in ways that they can make sure some of the incumbents don't get a lot of the data that they already have and just beat them at their own game?
Well, I think, and this comes up all the time, and I think both of them as entrepreneurs will attest to this, it's really a culture and DNA issue. If you are building a great technology organization with terrific engineers, established and very high vision product people, it's very difficult for an incumbent to compete. They don't have that talent, they don't have that culture, and it's difficult because they create data gravity in their businesses that then compounds. And so at some point you reach a scale where the ability to compete is sort of thwarted by the scale of data and process that you've put in place with the teams you have. And that's why we advocate for early engagement. And I think both of them have done this in their businesses. They've engaged with the industry and figured out win-win solutions to say, you have expertise, whether it's in home building or commercial real estate, you can come into our platform and invest or build a business product out with us. Because otherwise, it's very clear, these legacy businesses that don't leverage technology will get left behind. And I think I credit the real estate industry and specifically our anchors who have really come to the table with an open mind and engaged with these businesses, actually both of them. So.
Got it. And then, it's only been a week so far since you guys announced the other products. How's the reception been so far? I had an ad for Cadre on my Insta stories last night, so you're obviously
really?
marketing for it.
Yeah, we just started marketing. We hadn't marketed, this quarter is when we started doing that. And again,
I don't know how many family offices are watching Insta stories.
Right, no, but that's the point, right? We're actually
target for you.
We're going after. You asked about when we were going to reach out to you, so we figured target. But we want to go after individuals, right? That's part of the goal. And even in our partnership with Goldman, where they committed $250 million or closed $250 million from their private wealth, the end investor was still individuals, just qualified purchasers versus accredited investors. In terms of the reception to our secondary marketplace, we've had multiple trades just over the last week. And frankly, I think it's a function of, again, people just trusting that we've built the secondary market where they can get pricing parity, information symmetry. And if you think about the traditional secondary market in real estate and alternatives, there are some secondary funds, and they pride themselves on being able to buy at pretty big discounts because there's not that information parity between buyers and sellers. And what does tech do really well? Well, it sort of levels the information playing field. So we've seen a lot of engagement from folks because they now come to the platform and they say, well, this is the exact same experience as if I were buying, except there's price discovery. On the managed portfolio, so the Auto Invest, which is another product we launched, basically allowing individuals to now invest in almost a diversified format. We've seen tons of requests as well, more over the last week than we've had in a long time, even from the bigger institutions. And when you look at the overall usage, I mean, we have 100% year-over-year growth on our individual investor count, as well as capital invested. And again, I think it's all these dynamics related to liquidity and access coming together to really encourage more people to participate.
Right, and when are you going to be able to, I know last time we spoke, you said you had a wait list to be able to get onto the platform. Has that opened up a little bit? Or are you still having to turn people away just
it's the
lack
marketplace
of...
challenge, right? It's like supply, demand, supply. So what we've been able to do is really earmark a lot of, or a portion of our deals for individuals. And so basically the way our platform works is there's roughly a little bit more than 50% allocation that goes to our managed portfolio institutional investors. We wanted them to be able to get in and not get locked out because of syndication, velocity. And then what we've done is we've allocated another third to 50% for deal-by-deal co-invest investors, and so they can now participate without being locked out. So it's an allocation game. It's a supply-demand challenge. We're going to need to start thinking very soon about how do we start onboarding even more types of properties faster.
Does that happen sooner than I think, or do I have to wait a little while for that?
It depends what you mean by sooner. But I think that we will have some really interesting partnerships in terms of supply side scale within the next year, for sure.
Got it. And then for JD, you guys recently had a large round a couple months ago, and SoftBank was one that was involved. And with all the Saudi news recently, I know that's been sort of a controversial topic. Has that been a concern for you guys at all, or what are the feelings internally on that?
I think that that's a hard question, right? It's the one everyone likes to not get asked.
Sorry.
I think like what Saudi Arabia allegedly did is like incredibly barbaric, right? And I think we're all humanists individually. I think it's easy to not just like announce that, but say like that's completely illiberal and against everything we stand for if it's true. Now, you can hold that view and also say, like, yes, like 2 layers upstream from us, they invested in a fund, and that's probably true for any public company and any company. The hope is that this kind of controversy leads to changes in Saudi Arabia, and that the capital becomes, better in that way. I think that they're sort of separate topics. One is like capital, and one is like humanism and human rights. Right. And I'm on the side of focusing on the human rights side.
Got it. And on the topic of SoftBank, I know that you guys were talking to a number of investors very recently, and there was a story that me and some colleagues wrote about you guys having a term sheet for about $2 billion for your evaluation, which would be a massive jump from your last round. Is there any update on that?
Jump, but yeah,
it's a pretty big jump.
Yeah. Yeah, it's a question no one wants to answer. Just trying to use one of your lines.
Yeah.
So the question was what specifically?
What's the status on funding? Do you have any deals that have closed recently?
So we're really fortunate to have a lot of folks interested in the business. We don't normally or ever publicly discuss until the round's closed, and we're going to kind of maintain that policy for the time being.
Got it. And then one other thing, sorry, this is another tough question for Ryan. You said you're a co-founder of Cadre, and one family that is very well known in the real estate business is the Kushners, and it's sort of been a controversial topic as of late. Do you regret having them co-founded? I know you guys met in school, you're good friends. Like, what's the status of that relationship? Because I don't think they have much involvement in the company anymore.
Yeah, no, well, that was really loud. I guess you really want to hear this answer. So they, they're not involved, and we're fortunate to have dozens of investors. I mean, we have almost like the political spectrum. If you look at people that are on our cap table, 2014 was a very different time from where we are today for a lot of different reasons. And my focus was really identify and find partners who were best in class in their domains. And at that time, again, we were in a very different political environment, economic environment, and that was my focus. So Josh, from a VC and tech perspective, was and still is one of the most incredible investors I know. I know Fifth Wall guys. Josh, from a real estate tech perspective, was one of the very first people to really build a brand. Compass, some of 42 Floors, Honest Buildings, a lot of those companies, and I wanted to align myself with that. Jared at Kushner Companies was building an incredible platform there, right? One of the first investors actually in this market in Brooklyn before many, and I actually know some large real estate private equity funds that said that were actually trying to tour the area just to get his view and insight. So similar to Goldman Sachs, Ford Foundation, SL Green, who made one of their first private investments in more than a decade, we've always been focused on identifying the best partners and partners that will allow us to really scale and realize our mission of improving more people's futures. That was true then, and I don't regret that decision then because it's led to a lot of what we've been able to see now, focus on quality.